When markets crash, most investors lose money and peace of mind. But one type of investor keeps getting paid, while the other panics and sells at the bottom. The difference isn't intelligence, it's strategy. In the next 10 minutes, you'll see what actually happens to dividend stocks and growth stocks during real crises. Not opinions, not theory. Real behavior from 2008, 2020, and why the next crisis will reward a very specific setup. This isn't about predicting the crash, it's about surviving it, and being ready when everyone else isn't. Every major crisis follows the same emotional sequence: shock, fear, forced selling, regret. Prices fall fast, but not evenly. During the 2008 financial crisis, the S&P 500 dropped roughly 57% from peak to bottom. But when you zoom in, something critical appears. Growth stocks collapsed harder. Companies built on future expectations lost confidence overnight. Some fell 60%, others 70%. Some never recovered. But here's the part most people don't remember. Dividend-paying companies fell too, but less. And while prices dropped, something else kept happening. They kept paying cash. And that single difference changes investor behavior in ways most people don't understand. Growth stocks are priced on tomorrow. When you buy a growth stock, you're paying today for profits expected years in the future. That works beautifully in bull markets. Optimism is high. Risk feels low. Future projections feel safe. Then a crisis hits. Suddenly, investors demand much higher returns to hold risk. Think of it like gravity increasing overnight. Future profits get pulled down harder. At the same time, growth expectations shrink. 30% growth becomes 10. 10 becomes 0. 0 becomes contraction. Same company, different assumptions, much lower price. That's why high growth stocks fall fast when fear shows up. They don't collapse because the business disappears. They collapse because confidence disappears. But if growth stocks fall harder, are dividend stocks actually safe? Let's be clear. Dividend stocks do fall during crashes. Nothing is crash-proof, but they fall differently. Companies that have paid dividends for decades don't protect payouts lightly. Cutting dividends destroys trust. Institutions sell immediately, so management fights to keep them intact. During 2008, companies like Procter & Gamble saw stock prices drop roughly 30 to 40%, but dividends didn't stop. They increased. That means something important happened psychologically. Growth investors saw only red numbers, losses, fear, regret. Dividend investors saw cash hitting their accounts quarter after quarter. That income creates emotional stability. It gives investors a reason to hold when fear peaks, and behavior matters more than math during crashes. But here's the uncomfortable truth most dividend investors ignore. Past crashes were deflationary. In 2008, prices fell. Cash became more valuable. Dividends bought more over time. But today's risk is different. We're facing stagflation, slow growth with persistent inflation. That changes the rules. A 3% dividend doesn't protect you if inflation runs at 5%. You're getting paid, but losing purchasing power. Meanwhile, certain companies can raise prices without losing customers. Software, platforms, energy, infrastructure, these aren't speculative startups. They're pricing power businesses. So the old rule that dividends equal safety is no longer enough. So what actually survives this type of crisis? Stop thinking in categories. Start thinking in scenarios. Scenario 1, deflationary crash. Credit dries up. Demand collapses. Dividend aristocrats win. Cash flow matters more than growth. Scenario 2, stagflation. Costs rise. Growth slows. You need pricing power, not yield. Growth of income. Scenario 3, soft landing. Speculative growth survives, but this scenario is the least likely. So what's the rational setup? A hybrid approach. Dividend growers that raise payouts faster than inflation. quality growth companies with pricing power, cash for optionality when fear peaks. This isn't about being right, it's about not being forced to sell. When the crash comes, it won't feel logical. Growth stocks will fall fast. Dividend stocks will fall slower. The media will scream panic. Your instincts will scream sell. That's when this framework matters. Income lets you wait. Quality lets you recover. Cash lets you act. Crashes don't destroy disciplined investors. They expose undisciplined ones. Dividend stocks protect capital. Growth stocks capture upside. Investors who survive don't try to predict crashes. They prepare for uncertainty. If you value frameworks over hype, subscribe, and like the channel, it helps this content reach more people. Disclaimer: this video is for educational and informational purposes only. It does not constitute financial, investment, or legal advice. Every investor's situation is different. Always consult a qualified financial professional before making investment decisions.